Hi friends, a small intro video before you see the main video. Uh, these are concept revision videos for AFM, costing or FM. Objective is very simple. Learn concepts with limited amount of time. Post concepts, do practice. These are applicable for first time learners as well as new learners, and these are taken from my regular or exam oriented sessions. Now you move to the main video. Okay, let's proceed now. I now start with one basic chapter called as time value of money. This chapter as such is not there in the material. There is no chapter called time value of money, but this becomes the base for me to discuss the entire part. You've already learned this in CA foundation, maybe called mathematics for finance or something. So you have learned this, but still considering the importance of this chapter, I will spend around 1.5 hours on this chapter first, and then only we will go to the specific chapters which I want to discuss. First, let me spend some time on why this discussion is needed. Now, there is this chapter name is called 7A. There's no chapter 7A in your study material. You don't have a chapter on time value of money, but almost all faculties start the discussion of the subject only with the time value of money. Now, what does this concept say is that the value of money normally changes with the time. What is normally changes with the time? For example, I have to give you rupees 1000. I pay 1000 today and I pay 1000 years later. Both can't be same. Paying today 1000 or paying 1000 rupees a 5 year later. Both can't be said as same, because paying today is different, paying 5 years later is different. Which is better, which is weaker, and all will understand. But both are not same. Both are not same. Which is preferable? Do you want 1000 today or 1005 years later? Today. Why today? Same 1000 only, no? Same 500 rupee note. Okay, so what I can buy with 1000 today is different. Or to put it very simple, 1000 today, the real value is 1000. Today 1000 rupees, real value is also 1000. 5 years later, the real value of 1000 could be 800, could be 700. That is, 5 years later, with 1000 rupee, what you can purchase today, the same thing could be purchased with only 800. Today, the same thing could be purchased with 800. Same 800 of today is technically like 1000 a 5 year later. It's technically like 1000 a 5 year later. Or today, what you can do with 1000, you may need 1300 a 5 year later. You may need 1300 a 5 year later. So, concept is very simple. What I can do with 1000 today, cannot be done with the same 1000 a 5 year later. What I can do with 1000 today maybe can be done with 1400 a 5 year later. Maybe done with 1400. So what does this now say? This says certain things. 1000 today is greater than 1000 5 year later. This is my first conclusion. 1000 today is greater than 1000 5 year later. Second conclusion, 1000 today is equal to 1400, some random number. Okay, don't worry about whatever number I write. 1400 year later. Today's 1000 is like what? 1400 a 5 year later. Or you can say 800 today is equal to 1005 year later. 800 today is equal to 1005 year later. Don't worry about the numbers part of it, but the concept is very simple. The concept says what is 1000 today is not same. What is 1000 today is not equal to 1000 a 5 year later. Is not equal to 1000 a 5 year later. When I do any investment, For example, I want to construct a new coaching institute. For constructing the coaching institute, I will be paying lakh today. Today I have to pay 50 lakh. What I will get back? First year I'll get back something. Second year I'll get back something. Third year I'll get back something. Fourth year I'll get back something. Fifth year I'll get back something, because coaching institute started on day zero by spending money. But returns from that coaching institute doesn't come immediately. It does take time. So what happens is I invested 50 lakh. I got back 15 lakh in first year. Got back 10 lakh in second year. Got back 30 lakh in third year. Got back 20 lakh in fourth year. So this is year zero. I invested money. After investment money, I started taking classes and all there. Bharadwaj Institute opened a new branch and all. Year 1, I earned something. Year 2, I earned something. Year 3, I earned something. Year 4, I earned something. Now, I cannot say profit is 25 lakh. This is what accounting will do. Accounting will say profit is 25 lakh. In a books of accounts, what will you record? 25 lakh profit. But in reality, that 15, 10, 30, 20 is different time period. So this 15 which I get in the first year, the real worth of the 15 could be 14 lakh or 13 lakh or 12 lakh. I don't know. I'll have to get to some number. The real worth could be different, and what you get is different. So you cannot say that I gave 50 lakh. For example, I give 50 lakh. I don't get anything here, and I get back 51 lakh. Now you can't say I earned 1 lakh. Most probably I lost money here. Most probably I lost money in this example. Most probably I lost money in this example, because I gave 50 and earned 51 after 4 years. With that 51, I can't even achieve what I achieved today with 50. I can't even achieve what I achieved with 50 today. Able to understand first the concept? Concept is very simple. Whenever I'm doing investment, because we'll evaluate investment decision. Whenever I do investment, I make an investment. I get back the money. I understand I get back the money. But the worth of the two is not same. The worth of the two is not same. What you get back and what you invest can't be just like that simply added. You can't just like that simply add. In your accounting, first year profit, second year profit, third year profit, fourth year profit. If I ask you total profit, you will say 4-year profits, this much is the profit. How much is the profit minus investment? You will give me the number. That is accounting. Accounting will keep adding numbers. But that is not logical, because the worth of the money keeps changing with time. The worth of the money keeps changing with time. Any doubts on the concept? And what does the concept say? 1000 today is greater than 1000 a 5-year later. Or 1000 today is equal to 1400 a 5-year later. Or 800 today is equal to 1000 a 5-year later. So different conclusions can be made. So if somebody says I invest 1000 and I get back 1300, I get back 1300 5 year later, I lost 100 rupees. How did I lose 100 rupees? 1000 today, I get back only 1300, whereas 1000 today is worth 1400. 1000 today is worth 1400 5 year later. Somebody tells me invest 1000, get back 1300, earn 300. I say wait, I'm not earning 300. 1000 today is worth what? 1400 5 year later. That value should become 1400. 1000 today should become 1400. How can it become 1400? Invest in fixed deposit, invest somewhere, money will go up. You have 1000 rupees kept at home in your almirah. If you keep 1000 rupees, that 1000 value will go down to 700. Value will go down to 700, 800 in 5 years time. In 5 years time. So if you have money, you need to invest it. Where do you invest? Land, building, plant, machinery, or financial assets, or financial assets somewhere. Or you don't want to invest money, consume the money. Consume the money. What is consume? Spend the money. Consumption is also okay. Investment is also okay. Keeping money idle is the biggest mistake you can do. Keeping money idle is the biggest mistake. Is the biggest mistake you can do. Either invest it or consume it. And this is what the base of time value of money says. Time value of money says value of money changes with the time due to inflation. 100 today is greater than 100 a year later. 100 today is greater than 100 a year later. Today's 100 is obviously more worth than 100 rupee a year later, 2 year later, 3 year later. I can say 100 today is equal to 1150 a year later, or 1500 5 year later. What number we take, that and all is depends on extra information, but logic is very simple. First thing, I cannot add cash flows happening at different time period. You cannot be adding cash flows happening at different time different time period. They have to be at the same time period. They have to be at the same time period. If they are occurring at different time period, they can't be added. Able to understand this? Now, in the practical world, RBI fixes interest rate like this, and that interest rate is what will decide the time value of money. If interest rates are very high in an economy, the value of the money will deplete at a very higher rate. Reason? Interest rate is dependent on inflation. There are economies like one classic example, Argentina, where the inflation is 50%. If inflation is 50%, what will happen? What you achieve with 100, you need 150 a year later, then you need 225 a year later. So your money value will keep depleting at a very rapid rate, if you have a very high inflation. The RBI role is to control inflation. They ensure that inflation is in check. Time value of money is dependent on, one is inflation, that is the interest rate. Any interest rate you fix is dependent on inflation. Then there's something called as real return. What is real return? Is inflation 6%. Can you give me extra 2% earning? Extra 2%. That is called real return. Somebody tells I created an FD and 8%. No, you did not earn 8%. You earned 8 minus 7, 1%. What is 7? Inflation. Inflation pulls down the value of money. Interest income increases the amount, not value, increases the amount of money. So you had 1000. You make it 1100 by the end of the year. Worth may continue to be 1000. Or worth may become slightly more than 1000. That is real return. There is a real return which you need to earn. First thing is inflation. Second thing is called real return. On which investment? Risk-free investment. What is risk-free investment? Government of India bonds. Today, if you look at the inflation, will have an impact on the interest rate. Inflation will have an impact on the interest rate. If inflation goes up, interest rates go up. If inflation go down, interest rates go down. Whenever RBI increases interest rate, you be mentally prepared to see that the reason is inflation increase. Now there is a growing concern that inflation in India may start going up in case the crude prices, the petrol prices have not changed in India. Petrol prices is dependent on crude oil. Crude oil prices have touched 110, 120 a dollar. It used to be 60, 70. So if crude starts going up, petrol prices will go up. If petrol prices start going up, inflation will go up. If inflation starts going up, interest rate may go up in the economy. So somewhere it is very critical that interest rates are kept on check. Why? Because if interest rates keep going up, no companies would want to do investments. Because for investment, I need money. For needing money, I have to raise money. For raising money, I have to pay interest. So if interest starts keep going up significantly, the economy may not want to do investments. So somewhere RBI role is to keep the interest rates under check. For that, inflation has to be under check. They play with the interest rate with the inflation, because when inflation goes up, interest rates go up, money supply gets restricted, inflation starts going down. All this you would have learnt in economics. So inflation plus something called as real return. For example, in India, inflation is 6%. Real return means how much you earn on government bond. Real. Risk-free means government bond. Okay. In India, government bond or SBI FD. SBI FD is like risk-free. Inflation 6, real I earn 1. Then risk premium. What is risk premium? Is whenever you give a loan or you take a loan or you invest money, there is always a risk angle. SBI FD doesn't have risk. SBI FD doesn't have risk. So I want to earn 6 plus 1. If the same money you want to give to ABC Limited, unknown company, ABC Limited, you may charge extra 3%, 2%, 4%, 5%, 6%, whatever you want to charge. This is how interest rates are determined in the practical world. Interest rates is dependent on inflation, real return, and risk premium. Inflation, real return. The entire chapter which I'm explaining has nothing to do with most of the concept or problem solving, but this becomes the base. I will discuss these points at some places, but not critical from an exam point of view, but this becomes the base. I'll repeat again. Inflation. What is the inflation of the economy? Real return. What is real return? Is how much extra on which? On risk free. On risk free. And there is a risk premium. There is a risk premium. This is how interest rates are determined. If interest rates are very high, that 1000 today may become 2000 a 5 year later. 1000 today may become 2000 a 5 year later. In Argentina, 1000 today will become 1500 a year later because inflation is very high. Inflation is very high. So RBI role is to control inflation to ensure that we do not suffer, to ensure that we do not have the value of the money depleting at a faster rate. When I was a student, I used to manage my daily expenses with 10 rupees. That was the time 15 years back. Now with 10 rupees, impossible for us to manage our daily expenses because what used to be 10 rupees for me could be now 50 or 100 for you. It could be like a 50 or 100 for you. And when my parents were there, for them 10 was not there. It was only 1 rupee. It was only 1 rupee and they were able to manage the expenses. So what was 1 rupee daily expense for a student became 10 rupee when I was a student, and now it could have reached a 50 or 100. It could have reached a 50 or 100 or even more it could have reached. This is the situation at which the value of the money has gone down. The value of the money has gone down and this will continue to go down. So FM basically says, somebody says I invested 50 lakh. Investing 50 lakh and getting back 10, 10, 10, 10, 10 for 7, 8 years does not mean you earn 30, 40 lakh. There is a time value of money. There is a time value of money. What is that time value of money? There is something called as discount rate. And what is that interest rate? Interest rate is sum of the three. Inflation, which is not under control, along with that real return which the government of India wants to give, along with that risk premium. Risk premium depends on riskiness of an investment. Depends on riskiness of an investment. Any doubts till this? Able to understand this? Okay. With the context of this, I start with the first thing, nothing for you to write down. When I do problem, that time alone, you will write something. First concept is called future value. First concept is called future value. Now, what is future value is? Future value is value of today's money. Value of today's money compounded at time value of money. What is compounded? You would have learned about something called as compound interest. Now, what is compounding? Very simple. Listen. Year 0 values 1000. Year 0 values 1000. I want to know year 5 value. I want to know year 5 value. Let us assume interest rate is 10% in the calculator. Open calculator. 1000 plus 10% do 5 times. Plus 10% 5 times. Plus 10% 5 times. Later I'll give formula and all. Plus 10% 5 times. 1000 plus 10% plus 10% plus 10% plus 10% plus 10%. How much you get? 16,000 plus 10% for 5 years. Nothing for you to write down. When I tell you to write something, you do. Otherwise, be in listen mode only. 1000 plus 5%, 10% for how many years? 5 years. 10% for 5 years. Okay. Year 3, 1500. Year 3, 1500. You want to know year 7 value. Listen. Year 3500. See, normal definition is today's money. Today's money means year 0. But it can be any time period. When you take it to a future time period, you use future value compounding. There's something called a simple interest and compound interest. So 1500, if you want to take it to year 7 of year 3, add 10%, same 10%, 4 times. Same 10%, add how many times? 4 times. 1500 year 3 value. I want to take it to which year? Year 7. I want to take it to year 7. Add what? 10%, how many times? 4 times in the calculator. 1500, 10%, 10%, 10%, 10%. 2 1, 2 1, 1000 plus 10% for 4 years. 1000 plus 10% for 4 years. How is this calculated formula and all? I'll come to in some time. Okay. Basic concept is very simple. A 2021 value, let's assume you want to take it to 2025, add interest for 4 years. 2025 you want to take it to 2029, add interest for 4 years. 2029 you want to take it to 2035, add interest for 6 years. When you want to take it to a future time period, we add interest. When you want to take it to a future time period, we add interest. Clear? Sometimes let's assume year 1000 and year 4 2000, take both to year 5. I want to take both of this, which period? Year 5. Take both of this to year 5. Our rate of interest for entire discussion is 10% only. I'm not changing the rate, okay? I want to take both of this to which year? Year 5. Year 1, what is the value? 1000. You want to take it to year 5. Add how many years interest? Participate, guys. Add how many years interest? 4 years interest. Add 4 years interest. Year 4, what is the value? 2000. You want to take it to year 5. Add how many years interest? 1 year interest. Add 1 year interest. No need to do calculation. No need to do calculation. This is called future value. This is called future value. What is future values? Taking it to a future time period. This means today's 1000 is worth 1610.51. It's not worth it. The amount is 1610. Value is same 1000 only. Value same. 1000 of today and 1610 of 5 years both are same. 1000 of today and 1610 of which year? 5th year. Both are same. Both are same. Any doubts on this? Any doubts on this? Now comes the formula. Everything is there in the book. You need not write anything. Future value is equal to P into present value into the formula. Tell me the formula. 1 plus R power N or T, whatever name you want to give. 1 plus R power N. 1 plus R power N or R power T. R power T. P is called principal or present value. P is called principal or present value. Future value or amount. You would have learned the formulas. Amount. A is equal to P into 1 plus R power N. A is equal to P into 1 plus R power N. Any doubts on the concept here? This is called future value. Why do I take it to future value? Very simple. You took 1000 rupees from me today. You're going to repay after 5 years. And you're saying you'll pay 1000. No, I say don't pay 1000. Pay me 1610. Pay me 1610 after how many years? After 5 years. After 5 years, you have to pay how much? 1610. Then only take the 1000. Otherwise, don't take it. Otherwise, don't take it. You want to take 1000 from me today. Are you ready to pay 1610 in how many years? 5 years. You are saying, no, I will not pay 1610. I will pay you in 4 years. I said, okay, you are paying in 4 years. I will do in the calculator. 1000 plus 10% for 4 years and tell you the amount. 1000 plus 10% for 4 years. 10% for 4 years and tell you the amount. Able to understand the concept? Any doubts on the concept? I'll repeat again. You have taken 1000 from me. You want to return the money. You want to return the money after 5 years. So how much money will you return? Or other example, my father created a fixed deposit with the bank, 1,000 rupees, 5 years, 10%, and he asked me, after 5 years, how much money will we get back? After 5 years, how much money will we get back? I say, don't worry, I learned time value of money. I'll do the calculation and tell you, and I tell 1610.51. I tell 1610.51 with my analysis. With my analysis, I tell what? 1610.51. Able to understand the concept? Any doubts on this? Purpose are many, but objective is simple. If you invest the money today, what will you get back after 5 years? Later analysis will be present value analysis, which we'll understand as we proceed. It can be single future value calculation, 2 future value calculation, 10 future value calculation, 15 future value calculation. Rule is very simple. From year 0, you're moving to year 5, 5 times add it. From year 2, you're moving to year 5, 3 times add it. Year 3, you're moving to year 5. See, I have year 0 one investment. So my father said we are going to invest 1 lakh rupee today, 2 lakh rupee a year later, 3 lakh rupee 2 year later, 1 lakh 54 year later, 2 lakh 55 year later. What will we get back at the end of 10th year? What will we get back at the end of 10th year? First year 0 add 10 times interest. Year 1 add 9 times interest. Year 2 add 8 times interest. Year 3 add 7 times interest. Year 4 add 6 times interest. Year 5 add 5 times interest and get the value This is the purpose of understanding this concept. Very simple question is asked to you as a chartered accountancy student. Your parents are asking that if we are investing, please tell what we get back. Please tell what we get back, and you have to do the analysis and tell. Clear? Able to understand the concept? Any doubts on this? Let's do a problem on this now. Any doubts on the concept? Future value is tomorrow's value of today's money. Tomorrow's value of today's money compounded at time value of money. Compounded at time value of money. Compounded means increase the value. Something called as discounted, decrease the value. Compound will increase the value, decrease the value. Increase value, decrease the value. Value means the normal number. Worth means what is the worth of that, because value, worth are interchangeably used. But the concept is very simple. If you are investing 55,650, it will become 225. But the worth is not 225. Worth will not become 225. Worth will not be 225. Worth is going to be very less. Worth is going to be very less because of inflation. Because of the inflation. Able to understand the concept? Any doubts till this? Clear? This is there in our concept book. Concept book, page 44. Come to page 44 of the concept book. Concept book, page 44. Concept book, page 44. Time value of money. Value of money changes with time due to inflation. 100 today is greater than 100 a year later. What is the interest rate includes? Participate. It includes what? Inflation, real return on risk free plus the risk premium. What is future value? Tomorrow's value of today's money compounded at time value of money. Present value into 1 plus r power n. 1 plus r power n. Okay. We have understood future value. Now I proceeded. Nothing for you to note down. The next concept is present value. What is present value? Is today's value of tomorrow's money. For example, I am likely to give you 1 lakh rupees after 5 years. Instead of giving it after 5 years, today if I have to give you 1 lakh, what will be the worth of that? After 5 years, I'm going to give you 1 lakh. I want to know what is worth today. What is worth today? So present value is nothing but present value is today's value of tomorrow's money. Today's value of tomorrow's money. That was tomorrow's value of today's money. This is today's value of tomorrow's money discounted. Discounted at time value of money. Discounted at time value of money means discounted at some interest rate. Discounted at time value of money is nothing but discounted at an interest rate. For example, I want to earn 1 lakh rupee, or I want to get 20 lakh rupees after 15 years. If you want to get, or I want to get 2,25,138 after 10 years. I want to get 225,138 after 10 years. What should I deposit today? What should I deposit today so that I get 225,138 in 10 years? You should deposit 55,650. You should deposit 55,650. What you want? 225,138 after how many years? After, I want 225,138 after 10 years. I should deposit today 55,650. Should deposit today what? 55,650. This is what the concept is all about. Where is the utility of this? Utility is very simple. I want to, let's assume, repay debentures of 50 lakhs after 5 years. I want to create one deposit today for that. Repay how much? 50 lakhs after 5 years. One deposit, only one every year you create deposit, that's a different story. One deposit you want to create, you can use the concept of present value. I want 25 lakhs for the education of my kid. 25 lakhs for the education of my kid. If you want 25 lakhs for the education of your kid, how much should you deposit today? How much should you deposit today? That will also come from this area. Present value is today's value of tomorrow's money. Today's value of what? Tomorrow's money discounted at time value of money. Discounted at time value of money. Any doubts first on the concept? Now, how does these two work together? Let's understand this. We are in 2005. I want to go to 2010 and I want to go to 2015. 2005 is called present value. This is called future value. You want to go from 2010 to 2015. This is called present value. This is called future value. For the first analysis, 2005 is present, 2010 is future. For the second analysis, 2010 to 2015, 2010 is present, 2015 is future. Present value to future value is called compounding. Future value to present value is called discounting. You compound the value and go to a future time period. Discount the value, you come to present. What is compounding? Multiplying with 1 plus r power n. Multiplying with 1 plus r power n. What is discounting? Dividing by 1 plus r power n. Dividing by 1 plus r power n. Multiplying with 1 plus r power n. Dividing by 1 plus r power n. Present to future, future to present. 2010, when you compare with 2005, present value is 2005, future value is 2010. When you compare 2010 with 2015, present value is 2010, future value is 2015. The same year can be a present value, can also be a future value. I have a situation where I have some in 2010, some in 2011, some in 2012, and I want to take everything to 2015. No problem. 2010 to 2015 future value, 2011 to 2015 future value, 2012 to 2015 future value. Or you want to bring all these numbers to 2010, 2015 to 2010 discounting, 12 to 2010 discounting, 11 to 2010 discounting. You can do the discounting, you can do the compounding. Everything has to be brought to one time period. What is that time period? We are not getting into that debate. It has to be brought to a common time period. Common time period can be 2010, can be 2015, can be 2020, can be 2025, can be 2030. One time period you want to bring. One cash flow, one time calculation. Multiple cash flow, multiple times calculation. Any doubts on this? Any doubts on the concept? Clear? So I may want to move to present to future. That is called compounding. Future to present is called discounting. Future to present is called discounting. Any doubts on the concept? Can we proceed? Understood the calculation? Yep. Now right. Compute, right. Compute future value end of 10 years for the following. 5 columns. Year, cash flow. year cash flow 0 to 4, 1 lakh, 80,000, 40,000. What are those extra three columns and all? I'll explain. 0 to 4. 0, 2 and 4. 1 lakh 80,000 and 40,000. Now, the simple question I have is, I am going to deposit 1 lakh rupee today, 80,000 rupees after 2 years, 40,000 rupees after 4 years. Tell me how much will I get back after 10 years? How much will I get back after how many years? After 10 years. This is a question which your parents are asking you, saying that we'll create an FD of 1 lakh today, 80,000 at the end of second year, 40,000 at the end of fourth year, and I want value which year? 10th year. Listen, I need to take this to the 10th year. I also need to take this to the 10th year. I also need to take this to the 10th year. How will I take? Multiplying with the 10-year factor. Multiplying with 10-year factor. Future value factor for what period? 10 year. Multiplying this with 8-year factor. Why 8 year? Year 2 to year 10. Year 2 to year 10. What will you do here? Multiply with 6-year factor. Multiply with 6-year factor. Why multiply? Future value. We'll multiply with future value factor. Again, I'll repeat. Year 0 I have. This is a question I'm asking you. Very simple analysis you will do. First one multiply with 10-year factor. Second one multiply with 8-year factor. Third one multiply with 6-year factor. Next. Time period FVF. Time period for future value factor. Time period for future value factor. Time period for future value factor. What is time period is taking it to the future time period. How many years I'll take? Year 0 to which year I have to go? Right, time period is 10 years. 10 minus 0. 10 minus 0. 10 years compounding you have to do. 10 years compounding you have to do. Very simple question which anybody at your home can ask you, and you need to answer this. You need to answer this. 10 minus 0. Next one is 8. 10 minus 2. Third one is 6. 10 minus 4. Any doubts on this? I have to take it to 10th period, 8th period and 6th period. Future value factor at 12% rate of interest. I am giving the rate of interest as 12%. Now listen, in the calculator, no looking at factors, no looking at factor. In the calculator, 1.12 into 1. This is first year. Second year. When you come to 6th year, wait, okay. Third year, 4th year, 5th year, 6th year. When you come to 6th year, leave the number in the calculator, okay. Leave the number in the calculator and note down the number now. 6th year factor, note it down. 6th year factor, note it down. How many decimal? Let's do 3 decimal. That is consistently being done in exam question, okay. 3 decimal. I'll repeat again, okay. 1.12 into 1. There are other ways of doing it, whatever way you do. I'm not bothered about that. First year factor, second year, third year, fourth year, fifth year, sixth year. What is the sixth year factor? 1.3 decimal. 3 decimal. 1.974. Leave the number in the calculator, okay. Don't do anything in the calculator. 1.974. Any doubts on this? Press another equal to 2 times. Now tell me the 8th year factor. 476. These factors are there in the table, okay. I don't want to look at the table because table may be given, may not be given. We'll do only in the calculator. We'll do only in the, if they give table, write it directly, okay. Again, another 2 times equal to 106. I'll repeat again in the calculator. I'll repeat again in the calculator. 1.12 into 1 equal to first year, second year, third year, fourth year, fifth year, sixth year. 1.974. You can do 4 decimal, you can do 3 decimal. I'm with you either ways. I normally prefer doing 3 decimal. That is what exam questions will do. Last question we did 4 to show you the difference in the answer. But otherwise, normally 3 decimal. 1.974 equal to 2.476 equal to 3.106. Last column, future value. Future value. Now listen, what is future values? This 1 lakh multiplied with 3.106. 1 lakh multiplied. If you want present value, it would have been division. But that is year 0. Depends on the data given in the question. It can be division, it can be multiplication. Here we are doing future value. So 1 lakh into 3.106 is 3 lakh 10,600. 310 600. 310 600. 2.476. 198 080. 198 080. 78 960. Any doubts in this? How you got these numbers? By multiplying, by doing a multiplication. Total which I've got in live online is 587 640. Any doubts in this? Clear? Can we proceed? Any doubts in this? Done. Compute present value. Present value for the following. Same numbers, but today value I have to calculate. Present value for the following. Compute present value for the following. Year cash flow, extra columns will be needed. I think extra 2 columns needed. Extra 2 columns. Present value for the following. Year 0, year 2, year 4. PVF at 12% and present value. Future value I got FVF. Here I'll get PVF. PVF and FVF. Can we discuss? Okay, now listen. Year 0. Year 0 means, is it present value? Participate. Year 0, does it mean present value? So this is directly the present value. What will I do on top of it? Year 2 I can discount. Year 4 I can discount. Year 0 means it is present value only. Year 0 means it is present value only. So in the calculator, start with 1, divide by 1.12. This is first year. Again divide second year. Second year write value 0.797. Second year you are bringing it to today. Second year you are bringing it to today. That was second year to the 10th year, so I did 8 years calculation. This is second to 0. Second to 0. I'll repeat. 1 divided by 1.12 equal to first year, equal to second year, equal to third year, equal to fourth year. Fourth year is 636. 636. 636. I'll explain again. See, earlier we were taking year 0 to year 10, 10-year compounding. Year 2 to year 10, 8-year compounding. Year 4 to year 10, 6-year compounding. Year 0 to year 0, no compounding, no discounting. Year 0 to year 0, no compounding, no discounting. Year 2 to year 0, 2-year discounting. That is why divided 2 times. Divided 2 times, 2-year discounting. Year 4 to year 0, 4 times discounting. 4 times discounting. This one we normally write 1 only. 1 means it is the same value. 1 lakh into 1, you will get the same value. 1 lakh into 1. Year 0 to year 0, PVF, FVF is 1 only. If for example, in the calculation, there was a 10th year number and you want to take it to the 10th year, future value factor is 1 only for that. 10th year value, same. 10th year taking it to 10th year, there can't be anything. Now listen. Present value, listen for a minute. 1 lakh into 1. Into 1 is just a formality, okay? Into 1, I'll get the, listen for 2 minutes, okay? Same 1 lakh, listen for 2 minutes. This is 80,000.797. 80,000 into 0.797, and this is 80,000 into 0.636. Give me a minute. Okay, 40,000 into 0.636. Listen for 2 minutes. You'll get the present value. Whatever value you get here, you want to compound it with 3.106 from year 0, one value you got. You want to take that one value to the 10th year. You will get into 3.106, 587, 640, up and down rounding of difference. There can be some rounding of difference. Earlier what I did, year 0 took to year 10. Year 2 took to year 10. Year 4 took to year 10. Now what did I do? Year 0 to year 0. Year 2 to year 0. Year 4 to year 0. Now this year 0 number, I want to take it to the 10th year. I want to take the year 0 number to the 10th year. Or I want to take the 10th year number to year 0. Either ways you play around, you will get the same answer. Rounding of difference, I can't help. Rounding of differences will 100% be there. I'll repeat again. Year 0 took to the 10th year. Year 2 took it to the 10th year by doing 8-year compounding. Year 4 took it to the 10th year by doing 6-year compounding. This 587, 640 in bracket, technically this is 10th year value. This is 10th year value. Now you will get one value which is year 0 value. This year 0, you want to take it to the year 10, multiply with 3.106. Multiply with 3.106. Or you want to take that value to today value, divide by 3.106. Divide by 3.106. Will we get exact same answer? No. Up and down rounding of difference. Any doubts on this? Write the numbers now. 80,000 into 0.797. 63,760. I've got the answer in live online. 25,440. 189, 200. Just confirm these numbers. 189, 200. 189, 200. Any doubts on this? Either I go to the future period, or I go to the present period, or randomly I want year 5 number in between, not even year 10. I want year 5. I want year 5, year 0 to year 5 compounding. Okay, assume this question wants year 3 number. Year 0 to year 3 compounding. Year 2 to year 3 compounding. Year 4 to year 3 discounting. Year 4 to year 3 discounting. Fourth to prior period 1 year discounting. Year 0 to future period compounding. Year 4 to prior period discounting. I want all the 3 numbers on year 2. Year 0 compounding. Year 2 copy paste. Year 4 discounting. Year 4 discounting. Now 189, 200 in the calculator. 189, 200 into 3.106. You get 587, 655. Earlier we got 587, 640. 587, 640. Any doubts till this? Now comes the main learning for you. Any doubts till this first? Well, I just want to focus on this learning. Somebody tells me, I will pay you 189, 200 today. Listen, any doubts till this? Somebody tells me he will pay me 189, 200 today. Or 1 lakh today, 80,000 after 2 years, 40,000 after 4 years. Or 587, 640 at the end of 10th year. All three are same only. All three are same only. 189, 200 today, or 1 lakh today, 82nd year, 44th year, or 587, 640 only in the 10th year. Only in the 10th year. Technically, all three are same. All three are same. Any doubts on this? Any doubts in this? Clear? So for compounding, we multiply. For discounting, we divide, provided you have the future value factor. Here we have the present value factor. Present value factor means multiplication for present value. Future value factor means multiplication for future value. Multiplication for future value. Any doubts in this? Any doubts in this? Clear? Able to understand this? I'll repeat again. Getting 587 640 in the 10th year, getting 189 200 today, getting 1 lakh today, 80,000 in second year, 40,000 in fourth year. All the three are mathematically same. All the three are mathematically same, or from a time period point of view, all three are same. Can we proceed? Done. So we have done one number, then we did series of numbers and calculated future value, calculated present value. Any doubts to this? Okay, now something called as annuity. If you listen and then we do a question, or maybe I just discuss the concept today, not sure. Let's see first. What does annuity is? Equal payment or receipt. Equal payment or receipt. Whatever I'm typing there is there in the concept book. Okay, first I type and then I discuss that. Equal receipt or payment for specific time period. For a specific time period is called annuity. For a specific time period is called annuity. What is this? Let's understand. We wrote this year cash flow. We wrote year 0, year 2, year 4. Is it the same amount every year? No. Unless you have a same amount, it's not an annuity. First rule. Same amount, not an annuity. Okay. This is 1 lakh. This is year 3. This is also 1 lakh. This is also 1 lakh. Let me write, sir. Sorry. Year 1, year 2, year 3, year 5, year 6. Is it equal amount? Okay. Is it every year you are getting this? Fourth year it is not there. Fourth year it is not there in my example. If fourth year is not there, then it's not an annuity. Every time I want. Every time I want. What is annuity? Every time you should get it. Year 0 may be there, may not be there. That's a different story. What is year 0 and all? I'll explain later. Fourth year I don't see a number. Okay. Delete these two. Now it is an annuity. Now it is an annuity. Annuity means every time period we should get the same amount. Every time period we should get the same amount. Should it be year? No. It can be month also. Every month I am paying. 0 month means today. First month, second month, third month, fourth month, fifth month, sixth month, seventh month. Every month you are paying, then also annuity. Every quarter you are paying, also annuity. Every week you are paying, annuity. Daily you are paying, annuity. Classic example of annuity is rent. Rent is a classic example of annuity which is paid every month. Which is paid every month, and it is equal amount unless the rent is changed. Unless the rent is changed, the classic example of an annuity is rent. Classic example is rent. Okay. Now let us understand. Remove the year 0 for the time being. This is the rent I have to pay for the next 6 months. Next 6 months I have to pay 1 lakh, 1 lakh, 1 lakh, 1 lakh. I go to the landlord and tell, why are you disturbing me with paying 1 lakh every month? Can I pay today an amount? One amount I want to pay. He says, okay, pay 1 lakh into 6 lakh. Then I say, no, that is wrong. Where is time value of money in your analysis? 1 lakh you are telling me to pay first month, second month, third month, fourth month, fifth month, sixth month. You want me to pay today? Give me some discount. No, why should I pay you 6 lakh rupees fully? Discount is nothing but discounting of time value of money. In the practical world, they give you cash discount. Nothing to do with discount given. It is basically concept of time value of money. Concept of time value of money. So instead of paying 1 lakh, 1 lakh, 1 lakh, 1 lakh, I want to pay a single amount today. For the time being, let it be year, not be month. Month will unnecessarily confuse. Year. I will do the first number discount by 1 year. Second number discount by 2 year. Third number discount by third year. Fourth number discount by fourth year. Fifth number discount by 5 years. Sixth number discount by 6 years, and get today's value. Get today's value. Or I tell No, no, I don't want to pay today. I want to pay a single amount after 6 years. I want to pay a single amount after how many years? After 6 years. That is called future value. That is called future value. I may ask you that I want to pay a single amount today. That is called present value. I may also ask you that I want to pay a single amount after 6 years, provided you agree. That is called future value. One amount only I want to pay. I don't want to pay 1 lakh, 1 lakh. Like if this is the situation and I ask you I want to pay one amount today, you will say pay 189 200. 189 200. You want to pay one amount at the end of 10 years, you will say 587 640. 587 640. One option is to do PVF and present value for every number. PVF and present value. Be in lesson mode, nothing for you to write. So I attach two more columns here. PVF at 12% and DCF. PVF at 12%. DCF means discounted cash flow or present value. DCF means discounted cash flow or present value. Present value. I am again repeating the example. I have to pay 1 lakh at the end of every year for a period of 6 years. I got tired of all this. I said I don't want to pay at the end of every year. Please tell me one amount today. Please tell me one amount today. So I smartly said 1 lakh into 6, 6 lakh. Then you are arguing, no, that is not logical. Why will I pay 1 lakh plus 1 lakh plus 1 lakh plus 1 lakh plus 1 lakh today? Because there is a time value of money angle. No, that 1 lakh worth today is different. So PVF at 12% in the calculator, 1 divided by 1.12. 0.89 again equal to 797 again equal to 712 again equal to 636 again equal to 367. Nothing for you to note down. Okay, again equal to 307. Okay, so one option is to do every time this calculation, every year this calculation. 1 lakh same amount, time period is also same amount every time period. I divided, got the factor. I can multiply it here. It will become 89 300, 79 700, 71 200, 63 600, 56 700, 50 700. Can you quickly tell me the total of this? Quickly tell me the total of this. 4 lakh 200. 4 lakh 11 200. This is one guy took a lot of effort and did this calculation. Every year we did discounting. Okay, I explaining the example again. There's a equal payment or a receipt happening for a specific time period, that is called annuity, and I have done the calculation, got the value 411 200 present value. If you do FVF, you'll get future value. FVF is future value. What is FVF? Year 1 value compound 5 years. Year 1 value compound 5 years. Year 2 value compound 4 years. Year 3 value compound 3 years. Year 4 value compound 2 years. Year 5 value compound 1 year. Last year value no compounding, 6th year value directly. You can do compounding, you can do discounting, you can calculate present value, you can calculate future value. All depends on what is the requirement. Okay, I got this number. Another guy said, no, this is useless. Why should I do like this? I will write 1 to 6 together. Every year same amount. Every year same amount. So let's write only 1 lakh. Only once we will write. Only once we will write 1 lakh. Now in the calculator, do what I say. 1 divided by 1.12. Press equal to. Press equal to again. 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 6 times you should have press equal to. Press a GT button. Press a GT button. Press a GT button. You will get a value called 4.111. 4.111. What is 4.111 is? Total of all of this, again some rounding of differences can be there. 4.111. 1 lakh into 4.11 is 4 lakh 11,100. 4 lakh 11,100. Why is there a difference? Because we did work with 3 decimal. In the calculator, no rounding off has happened. It has just put a total of all the 6 numbers, zero rounding off done. In the end, you are rounding off. There, every year we did rounding off. Here, no rounding off has been done in the calculator. That is why subtle differences is coming. I'll repeat again. For present value factor, I will have the annuity amount. What is annuity amount? Is equal payment or receipt. Equal payment or receipt for a specific time period. For a specific time period. What is the time period? Can be 1 year, two, not 1 year, 2 years, 4 years, 6 years, 8 years, 10 years, 15 years. One option, struggle every year and do this calculation. Second option, sub all the amounts and get one factor 4.111. 4.111. Any doubts in this first? This is called annuity. Where is the utility of this? For example, I want to pay school fees for my kid, which is going to be 1,50,000 every year, same amount, which is rare, but every year same amount for the next 15 years, 1,50,000. What I will do is I'll do discounting of that, get one value today. That value I create a fixed deposit. That value I create a fixed deposit. Every year I will withdraw 1,50,000 from there. Every year I'll withdraw 1,50,000 from that FD. Automatically after 15 years that will become zero and fees would have been paid. The amount would become zero after how many years? After 15 years. This is one purpose. Second purpose, I want to pay insurance premium. I want to pay insurance premium. Every year you have to pay 20,000. Put all the total and get one value today and create a FD for that. Create a FD for that. Or other option, I'm going to give 20,000 to insurance company for next to 25 years. At the end of 25 years, what will I get back? My father wants to know. What will I get back after 25 years? After 25 years, do the future value factor. Do the future value factor. Like we did present value factor, you will have to do what? Future value factor. How will you do future value factor? Compound first year to 25th year, second year to 25th year, third year to 25th year. How the calculation and all is done, we'll understand in some time. Any doubts first on the concept? Any doubts on the concept? Now, in this annuity, there are two types. First type is regular. Regular means fees is my example, is paid at end of year. The standard got over and then fees is paid. Or let's take not fees, rent. Rent is paid at end of year. Normally rent month will get over. At the end of the month you will pay the rent. At the end of the month you will pay the rent. That is called annuity regular. Annuity regular means paid when? At the end of the year. Second type is immediate. Immediate means school fees is paid at beginning of year. You want to pay the school fees for the next 15 years. When will you pay? At the beginning of the year. When will you pay rent? At the end of the year. You could be paying at the beginning of the year or you could be paying at the end of the year. Calculation is little different for both. Paid at the beginning of the year, paid at the end of the year. There are two types of annuity. One is called regular, second is called immediate. Regular, paid at end of year. Immediate, paid at the beginning of year. How does it change the calculation? You will understand as I proceed forward. But there are two types. One is paid at the beginning of the year. One is paid at the end of the year. Able to understand the concept till this? Any doubts in this? This is followed if problem is silent. This is followed if problem is silent. Any doubts till this? And this example is called regular example. Okay, what happens in immediate and all I'll explain later. Not sure whether we'll touch today or maybe in tomorrow's session. Any doubts till this first? Clear? Okay, same requirement. I want to do future value. I want to calculate future value at end of 6 years. Future value at end of 6 years. At end of 6 years. Now, I am giving a deposit at the end of first year, second year, third year, fourth year, fifth year, sixth year, and my parents want to know what will be the money at the end of which year? At the end of sixth year. At the end of sixth year. One option. You can compound this itself to the sixth year because we already know this. We already know this. Just compound this one value to the sixth year. One value to the sixth year. You have got the year zero value. Assuming you don't do all that. And you have done this is the number. Now listen. Go back to here. Time period for future value factor, future value factor, and future value. Time period for future value factor, future value factor, and future value. Listen, first year you invest. This is 6 minus 1, 5-year compounding. 6 minus 1, 5-year compounding. Don't write anything because I am not going to do a question today. I just want to discuss the concept. 6 minus 1, 5. Next is 6 minus 2, 4. Next is 6 minus 3. Next is 6 minus 4. Next is 6 minus 5, 1. And last is 6 minus 6, 0. 6 minus 6 means no compounding on that. No compounding on that. In the calculator, 1.12 into 1. Listen, last year no compounding. Last year no compounding. Prior years 1.12, 1 year compounding equal to 254, 2-year compounding equal to 405, 3-year compounding equal to 1.574, 4-year compounding equal to 1.762. I'll repeat the explanation again. I have 1 lakh first year, second year, third year, fourth year, fifth year, sixth year. Sixth year value in the sixth year same, no effect extra, no extra effect. So sixth year 1 lakh into 1 will be 1 lakh only. Prior years into 1.12 you did equal to and you got the factors. Or total of all of this if you can get and just multiply with 1 lakh, then also it's okay. Total of all of this together you can get and then multiply also okay. Or every time you do it, or every time you do it, total together you can get, great, work is over. Or every time you have to do it, every time you have to do it. Able to understand the concept first? Listen, present value get by dividing, future value get by multiplying, get the factor and then do the multiplication. This will be 176, 200, 157, 400, 140, 300, 125, 400, 1 lakh 12 and 1 lakh. Tell me the total of all of this. Total of all of this. How much? 811 500. 811 500. 8 lakh 11,500. Any doubts till this? 811 500. So listen, 1 lakh at the end of every year for a 6-year period is worth today 4 lakh 11,000, worth 8 lakh 11,500. Are you getting 811,500? Okay. At the end of 6 years. Any doubts on this? Clear? Other option is, if at all I could have got this together, how will you get that together in the calculator? I'll explain. If I could have got this together, like present value, we got it together. Future value also, let us get it together and then close it. Rather than doing every year, why should I waste my time on every year calculation? Just get one number and then close it. Now this one number, listen. Future value factor for an annuity. Future value factor for an annuity. What is the rate of interest we are working with? 12%. How many years? 8.115. It will be 8.115. How you get in calculator? I'll explain. It will be 8.115. How you get in calculator is up to me. You wait for some time. Okay. 8.115. How it is 8? If you do 8.115, you will get 8 lakh 11,500. 8 lakh 11,500. 500. One option every year you do it. Second option smart work. Assuming the amount is same. Assuming the amount. Assume amount is different. You can't do all this. Equal amount. Equal amount. What does the factor say? 8.115. How will 8.115 come in calculator? That's up to me. I'll explain it. Any doubts on this? Okay. Then same 12%. 6 years, 4.111. 4.111 present value annuity factor. Present value annuity factor, future value annuity factor. Present value annuity factor calculator I've explained you. We'll do questions around this in the next session. I don't think I have time and I don't want to rush through. Okay. 4.111, how you calculate, I've explained. Now I have to explain you how will you get 8.115 in the calculator. Clear? Any doubts on this? Now start. 1 into 1.12 equal to first year, 1.12 into 1, sorry. First year equal to, second year equal to, third year equal to, fourth year equal to, fifth year equal to. Stop at fifth year, okay? Sixth year means stop at fifth year. Sixth year means stop at fifth year. Stop at fifth year. Sixth year means stop at fifth year. Put a GT button. Add 1 to that. Add 1 to that. Stop with 1 year less and add 1 to the final number. Stop with 1 year less and add 1, then only you'll get the factor. There are other ways of getting it. I'm not getting into other ways and all. I explain in this manner. If you have learnt in some other way, you can continue to follow that. Okay. I'm just giving you the way I am comfortable with. Whatever way you are comfortable with. If you know some other approach, please do that approach. No problem with that. I'll repeat again in the calculator. Do now. Into 1.12 into 1 equal to first year, equal to second year, equal to third year, equal to fourth year, equal to fifth year. Put a GT button. Add 1 to that. Add 1 to that. Why am I adding 1? Because factors were these. These were the factors. 1 is missing in the factor. 1 is missing in the factor. What you started with is 1.12, 1.254, 1.405, 1.574, 1.762. Those were the 5 factors. That's why I said 5 years, stop it. Stop it at 5 years. Don't do 6th year. Don't do 6th year. Stop it at 5th year and add 1. Add 1. Any doubts on this concept? Any doubts on this concept? Able to understand this? We have learned how present value factor is calculated. We have also learned how future value factor is calculated. Any doubts in this? There's something called as ordinary annuity and something called as annuity immediate. I will explain that in the next session and then we do a question around it. I'll explain what we have done today. We have learned about what is future value, what is present value for a single cash flow. Single cash flow, do PVF or FVF. PVF or what is PVF FVF? 1 plus R power n, 1 divided by 1 plus R power n. Okay. Do PVF or FVF, one number. You have multiple numbers, do for every number. Do for every number. Multiple numbers but same amount. Multiple numbers but same amount. Don't break your head in doing everything. Do it together with an annuity factor. Do it together with the annuity factor. Will they give the annuity factor in the question? High probability. If they give, great. If they don't give, in the calculator, I have explained something called as ordinary annuity. There's something called as annuity immediate, which I'm yet to discuss it. Okay. Ordinary immediate I've explained. Ordinary annuity I've explained. There is an annuity immediate, which I'll explain later. What you do for present value factor, I'll repeat again. 1 in the calculator, do with me. 1 divided by 1.12 equal to first year, equal 1 divided by 1.12 equal to first year, second year, third year, fourth year, fifth year, sixth year, GT button. 6 year annuity factor. 6 year annuity factor. At home, open the last page. 1 divided by some number you do, equal to do a GT button and check the number. Okay. You can do for any number, just 2-3 numbers you do. Okay. Then multiplication part. Then the multiplication part. 1.12 into 1 equal to first year, equal to second year, equal to third year, equal to fourth year, equal to fifth year, GT plus 1. GT plus 1. Any doubts on this? Able to understand this? Clear? Clarity is there? So we are kind of done with annuity discussion. There is still some discussion pending, which I do it in the next session. And then we go to the core subject area. Clear? Done? Okay, we'll end with this. Good morning. Okay, let's continue with the discussion. We have started with time value of money, where one major concept we have learned is that cash flow or inflow or outflow happening at different time period cannot be added or subtracted. If you get something in first year, something in second year, something in third year, you cannot say 1 plus 2 plus 3 is the overall amount received. That is wrong. Only thing is, like there is a cash flow, there is also a time period, and we need to bring everything to a common time period. The common time period could be day 0, that is year 0, or it could be a year 5, year 10, year 15. All cash flows have to be brought to a common time period. From a second year, if you're planning to go to third year, it is called compounding. From a third year, you want to go to year 0 or year 1 or year 2, it is called discounting. Either you have to do discounting or compounding and bring the cash flow to a common time period. The common time period can be anything. In the context of that, we learned first, if there is a single cash flow, what happens? Then there are multiple cash flow, what happens? Single cash flow, you will have one number which could be a future value or a present value. Present to future is multiplied with 1 plus r power n. Future to present is divided by 1 plus r power n. R represents the interest rate, which is dependent on inflation, something called as real return, and something called as risk premium. These are the three items put together. I get to know the interest rate which will be fixed. With the interest rate, I need a time period. The time period represents the future value time period and the present value time period gap. The future value present value gap can be year 5, year 3 gap. Then 2 years you have to do compounding, or 2 years you have to discounting. Year 2 to year 5 you want to go 5 minus 2 or 2 minus 5, 3 year compounding, 3 year discounting, depending on the requirement. Once you get that compounding discounting part clear, you multiply with 1 plus r power n or divide by 1 plus r power n. Multiplication with 1 plus r power n is called future value factor. Divided by 1 plus r power n is called present value factor, if the factors are given. Then we went ahead and saw, if you have uneven cash flow and multiple cash flow. Uneven means you have something in the first year, something in the second year, something in the third year, something in the fourth year, and you want to take everything to the fourth year, do compounding. You want to take everything to year 0, do discounting. For compounding, as I said, into 1 plus r power n divided by 1 plus r power n. Then we went ahead and saw something called as an annuity. Only point in the annuity we are learning is, it is a equal receipt or a equal payment. Because the amount is equal, what we understood is, instead of doing like this every time, why not, if it's the same amount, get the future value factors for every period and put a total in the calculator itself. Put a total in the calculator for the future value factor or a total for the present value factor, and then close the calculation. This is what we learnt in the previous session. In that, I had started with annuity. We have not completed the annuity part fully. I was to discuss certain extra points. Okay. Now, in the annuity, we learnt that there can be an equal payment or a receipt for a specific time period. That is called annuity. First type is called regular, where the amount is paid at end of the year or end of the month or end of the quarter or end of the half year. The second type, which is called immediate, where the amount is paid at the beginning of the year or beginning of the month or beginning of the quarter or beginning of the half year. In the context of this, I said how we will calculate future value for regular, future value for immediate. If it is regular, we have understood how to calculate the factor. And the other point is, if it is regular, if they give you table values, you can directly copy paste the table value. You can directly copy paste the table values if the table values are given as far as regular is concerned. How did we get the table value? Now in the calculator, I want to do present value annuity factor 10% 5 years. In the calculator, 1 divided by 1.1. This is first year factor, equal to second year, equal to third year, equal to fourth year, equal to fifth year, and a grand total. This is for present value factor. Present value is easy. 1 divided by 1.1 equal to GT button. This is if you want to do 5 years. If it is future value factor, if you want to do 5 years, 4 years only you will do the future value factor. put a GT and then add 1 and then add 1. This is as far as your annuity regular is concerned. How will you do future value factor? 1.1 into 1 equal to first year, equal to second year, equal to third year, equal to fourth year. Put a GT button and add 1 and add 1. This will give you the future value annuity factor for an annuity regular. Okay, let's now understand what is this annuity immediate and where is the difference coming in. Okay, immediate means problem we are not doing as of now. You be in listen mode. When I do problem, you can write it. Immediate basically means that payment or receipt happen at beginning of the period. For the time sake, for as of now, let's take it as year. Now, what is beginning of the period? Let us assume today date Jan 1, 2021. Today date is Jan 1, 2021. If the cash flow starts on Jan 1, 2021, if it starts on Jan 1, 2021, that is cash flow Jan 1, 2021, last cash flow Jan 1, 2025, 21, 22, 23, 24, 25, 5 times you will get. And the requirement is to calculate future value as on December 31, 2025. The end is December 31, 2025. The end period is December 31, 2025. So they are asking, can you calculate the future value for December 31, 2025? Or they are asking for present value as on Jan 1, 2021. Present value they ask it for Jan 1, 2021. Future value if they ask, they'll ask it for December 31, 2025, because after 5 years it is December 31, 2025. If it is regular, immediate, I'll repeat again. Today date is Jan 1, 2021. Cash flow happens on Jan 1, 2021, second on Jan 1, 22, Jan 1, 23, Jan 1, 24, Jan 1, 25, 5 cash flow story over. Start with Jan 1, 21, 22, 23, 24, 25, 5 cash flows you get starting from January 1, 2021, January 1, 2022, 23, 24, 25. Future values asked for December 31, 2025. Present values asked for Jan 1, 2021. In case of annuity regular, this is immediate. In case of regular, cash flow will happen on December 31, 2021 at the end of the first year. At the end of the first year. In case of immediate, beginning of the first year. Beginning of the first year. That is end of the first year. This is beginning of the first year. And this number, last cash flow will be December 31, 2025. Last one will be December 31, 2025. This is called immediate and the other one is called regular. Okay. Now, I want to do compounding or discounting. Compounding means take everything to fifth year. Discounting means take everything to year 0. Now listen. Okay, let's take 5-year example. Everything is same. If it is regular, it is going to be 1, 2, 3, 4, 5. If it's regular, it is going to be 1, 2, 3, 4, 5. The cash flow will happen at the end of first year, second year, third year, fourth year, fifth year. At the end of first year, second year, third year, fourth year, fifth year. I am trying to calculate value at the end of fifth year. Value at the end of year. No compounding. 1 year compounding, 2 year compounding, 3 year compounding, 4 year compounding. This is regular, which is what we did in the previous session. I'll repeat again. The first cash flow happens at the end of first year, second year, third year, fourth year, fifth year. Fifth year to fifth year, zero compounding. Fourth to fifth year, 1 year compounding. Third to fifth year, 2 year compounding. When it is immediate, my first cash flow, when it is immediate, first cash flow happens zero today itself. First cash flow happens today itself. The first cash flow happens when? Today itself. Immediate. Second cash flow will happen at the beginning of second year, which is called end of first year. Beginning of second year is called what? End of first year. So the cash flow is 0, 1, 2, 3, 4, and compounding is 1, 2, 3, 4, 5. Compounding is 1, 2, 3, 4, 5. Compounding is 1, 2, 3, 4, 5. Listen, I'll repeat again. In case of regular, 1, 2, 3, 4, 5. In case of immediate, 0, 1, 2, 3, 4. That is the only difference. Regular, 1, 2, 3, 4, 5. Immediate, 0, 1, 2, 3, 4. Every cash flow will have one extra year of compounding. Every cash flow. One more year compounding will happen. Every cash flow will have one extra year of compounding. Here, 4, 3, 2, 1, 0 compounding. And here, 5, 4, 3, 2, 1 compounding. 5, 4, 3, 2, 1 compounding. Every cash flow, one extra year you will earn. One extra year you will earn, or one extra year of compounding will happen. One extra year of compounding will happen. Regular 1, 2, 3, 4, 5. Immediate 0, 1, 2, 3, 4. Regular 1, 2, 3, 4, 5. Immediate 0, 1, 2, 3, 4. Future value 4, 3, 2, 1, 0. 5, 4, 3, 2, 1. Present value 1, 2, 3, 4, 5 means discount with first year, second year, third year, fourth year, fifth year. 1 divided by 1.1 equal to m plus equal to grand total. Then 0, 1, 2, 3, 4 means year 0 no discounting. 1, 2, 3, 4 you have to discount. 1, 2, 3, 4 you have to discount. Any doubts first on the concept? I'll repeat again. In case of regular, cash flow starts at the end of first year, second year, third year, fourth year, fifth year. Fifth year no compounding. Fourth year 1 year compounding. Third year 2 year compounding. Second year 3 year compounding. And first year 4 year compounding. In case of immediate, cash flow starts with year 0, then 1, 2, 3, 4. Starts with year 0, then 1, 2, 3, 4. Compounding will happen for one extra year. Compounding will happen for one extra year. Compounding will happen for one extra year. Because it is one extra year, whatever factor you get here, that factor will be multiplied with 1 plus r. That factor, whatever I explained earlier, will be multiplied with 1 plus r. Will be multiplied with 1 plus r, or there are other ways also to get it. I'll explain. Okay. First, I'm discussing the future value annuity factor. I'll repeat again. Cash flow starts immediately. Compounding will happen for 5 years, 4 years, 3 years, 2 years, 1 year. Cash flow happens after a year, that is end of first year. Then compounding will happen for 4, 3, 2, 1, 0. Now in the calculator, listen. Future value factor, 10%, 5 years, 10%, let's take it as 10%, 5 years. This is for annuity regular. How do we calculate for annuity regular? Let's understand that. We have already done it, but again we'll see. In the calculator now do 1.1 into 1 equal to first year, equal to second year, equal to third year, equal to fourth year. Put a GT button and add 1. What do your number you get? 1051. I'll repeat again. The calculator 1.1 into what? 1 equal to first year, equal to second year, equal to third year, equal to fourth year, GT button plus 1, 6.1051. Any doubts on this? Future value factor for annuity immediate 10%, 5 years. 10%, 5 years. Now listen. If it's annuity immediate, 1.1 into 1 equal to first year, second year, third year, fourth year, fifth year also equal to, and then put a GT. Fifth year also equal to, and then put a GT, and there's another way to get it also, I'll explain. Understand the thing clearly. See, here I wanted you to add 43210. 43210. First year you did, second year you did, third year you did, fourth year you did, got a GT button and added 1 because year 0 is 1. Year 0 part is 1. Compounding for year 0 is 1. Then here second year, third year, fourth year and fifth year in the calculator. 1.1 into 1 equal to first year, second year, third year, fourth year, fifth year and a GT button. And a GT button. What's the number you get? 71561. This number has another answer which is nothing but 6.1051 into 1.1. One more year of compounding. One more year of compounding. One more year of compounding. There's a doubt. I'll explain again. A student has asked me a doubt. In the calculator for first one 1.1 into 1 equal to first year, equal to second year, equal to third year, equal to fourth year, GT plus 1 plus 1 plus 1, 6.1051 plus 1, 1.1. We are doing 1.1 plus 1, 6.1051. I'll repeat again. 1.1 into 1 equal to first year, second year, third year, fourth year, GT plus 1. Clear? This is future value for what? Annuity regular. Annuity regular. If it's annuity immediate, you have the regular answer, no? You can do into 1 plus R. R. In the calculator, the logical way, 1.1 into 1 equal to first year, second year, third year, fourth year, fifth year and a GT button. 6.71561. This will match 6.1051 into 1.1. Extra 1 year compounding on every number. Any doubts on this? This is on future value. This is for future value. Any doubts till this? We'll write all of this in a question in some time. Okay. This is for future value. Any doubts on this understanding? Can we proceed? Okay. When it comes to present value, if it is regular, you will do PVF at 10% for 5 years, 1, 2, 3, 4, 5 and then get the total. 1, 2, 3, 4, 1, 2, 3, 4, 5 and get the total. This is for regular. How will you do? 1 divided by 1.1 equal to GT. If it is for 5 years, regular. If it's immediate, you need to get it for 0, 1, 2, 3, 4. What will you do? 1, 2, 3, 4 do in the calculator. Year 0 is 1. 1, 2, 3, 4 do in the calculator and year 0 is 1. I'll repeat again. Understanding more important is this. Why are we writing 1, 2, 3, 4, 5 and why are we writing 0, 1, 2, 3, 4? That is the most important part. Okay. 1, 2, 3, 4, 5, end of first year, end of second year, end of third year, end of fourth year, end of fifth year. 0, 1, 2, 3, 4. End of first year has now become beginning of first year. End of second year has now become beginning of second year. Beginning of first, beginning of second, beginning of third, beginning of fourth, beginning of fifth. Beginning of first is nothing but year 0. Beginning of year 2 is nothing but end of year 1. First year got over, second year started. Beginning of year 2 is end of year 1. Beginning of year 3, end of year 2. Beginning of year 4, end of year 3. Beginning of year 5, end of year 4. That is the most important one. 1, 2, 3, 4, 5, 0, 1, 2, 3, 5. 1, 2, 3, 4, 5 when we did compounding from the down order 0, 1, 2, 3, 4. 0, 1, 2, 3, 4 when we do compounding from the down order it was 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. So I told you to add the future value factor for 1, 2, 3, 4, 5. And then I told you to add the future value factor for 0, 1, 2, 3, 4. 0, 1, 2, 3, 4, what did I do? 1.1 into 1 equal to 4 times did GT added 1. 1, 2, 3, 4, 5 you want equal to 5 years do equal to put a GT. Any doubts till this? Any doubts on this? Then comes your present value part. Then comes the present value part. Present value part, if it's 1, 2, 3, 4, 5, in the calculator, 1 divided by 1.1 equal to GT button. 1, 2, 3, 4, 5. 0, 1, 2, 3, 4. Do 1, 2, 3, 4 and then add 1 to it. And then add 1 to it. So nothing for you to write down as of now. Present value factor or annuity regular. Annuity regular means 1 to 5. Regular means 1 to 5. You have to get the factor for which period? 1 to 5. How will you do in the calculator? 1 divided by 1.1 equal to first year, second year, third year, fourth year, fifth year, and a GT button. What's the number you get? 3.791 or 79. I normally do 3 decimal. So that's okay. As we proceed, you'll understand. 3.791. PVF for annuity immediate, which is 0 and 1 to 4. 0 and, or I can say 0 plus 1 to 4. 0 plus 1 to 4. 1 to 4 will come in the calculator. 0 is 1. 0 is 1. 1 to 4 will come in the calculator and year 0 is 1. How will you do in the calculator? Let's repeat. 1 divided by 1.1 first year, second year, third year, fourth year, GT, add 1. Add 1. What's the number you get? 17170. 4.170. Any doubts in this? This number will also match earlier PVF into 1.1 because the cash flow comes 1 year earlier into 1.1 into 1.1. Extra value will come because when it's immediate, higher present value you will have, also higher future value, higher present value as well what? Higher future value. I'll repeat again. When we did annuity regular, we had to get the future value factor technically for year 0 to 4, and the tables normally give it for regular. They give it for regular. You want it for immediate, whatever you got earlier into 1.1. Other option you have is in the calculator 1.1 into 1 equal to and then press a GT button. Then press a GT button equal to and then press a grand total button. This is as far as your future value factors are concerned. When it comes to present value factor, 1 to 5 is very simple. 1 divided by 1.1 equal to. You want it for 1 to 4 and then add year 0 and then add year 0. 1 divided by 1.1 equal to 4 times you do and then add the first year and then add the first year and then add the, that is year 0, then add the year 0 which is 1. Any doubts on this? In both the cases, immediate value will be 1.1 times of regular. 1.1 is 1 plus R. Immediate will be 1 plus R. 1 plus R. Extra 1 year compounding, lesser 1 year discounting. Extra 1 year compounding, lesser 1 year discounting. So the values go up, be it present value, be it future value. Any doubts on this? Able to understand first the concept? Now I show it in the book and then we do an example. If it's future value, use the future value annuity factor. If it's present value, use the present value annuity factor. If it is immediate, do into 1 plus R. If it is present value, again do into 1 plus R. Why is this 1 plus R being done? Extra 1 year compounding, lesser 1 year discounting. Lesser 1 year discounting. Other logical way, I have explained how you get the factor also. 1 to 4 and this. If they give the table value is great. If they don't give the table value, understand how regular is done. Immediate into 1 plus R. Immediate is into 1 plus R. Any doubts on the example here? Any doubts on this? Able to understand this? Can we proceed? Okay. Now I go to the next concept. Like we have annuity, the next concept, annuity we have learned, equal receipt or payment for a fixed period of time. If the cash flow happens at the beginning of the period, it's called annuity immediate. Happens at the end of the period, it's called annuity regular. If the cash flows is determined at day 0, that value is determined at day 0, it's called present value. Value is determined at the end of the period, it is called future value. Problem silent, it will be called what? Annuity regular. Annuity Regular. How do you calculate? Regular into annuity factor, regular into present value annuity factor, immediate into 1 plus r into 1 plus r into 1 plus r into 1 plus r. Any doubts till this? Okay. Now comes something called as perpetuity. Let's understand this first now. Perpetuity means there is no end at all. Perpetuity means there is no end at all. Now, two things can happen. There is one thing called normal perpetuity and the second thing called growing perpetuity. Both same formula only, but normal perpetuity means no growth will happen. Now, what is perpetuity? A bank says deposit, SBI says, deposit 20 lakh today, deposit 20 lakh today, get 1 lakh 40,000 every year for another infinite years. There's no end. No end means you will get it after you, next generation will get it, next generation, next generation. This is one. Deposit 20 lakh today, get 1 lakh 40,000 every year for another infinite years. Now, I want to know whether this is a good deal or a bad deal. It's a good deal or a bad deal. For doing this, we calculate value of perpetuity. Like we calculate value of annuity, value of perpetuity. Is there an end for a perpetuity? No. So if there is no end, there is no concept of future value of perpetuity. I cannot calculate future value. Future value means when is it ending? You have to tell me annuity ends in 5th year, 10th year, 15th year, 20th year, some time period it is ending. Perpetuity has no end. So only we calculate present value of perpetuity. We don't calculate future value of perpetuity. Basic thing I'm going to calculate is, you said deposit 20 lakh today. I will do the calculation, see whether 20 lakh is right or wrong by doing some calculation called present value of perpetuity, or SBI says deposit XX today, XX today and get 1 lakh 40,000 every year for another infinite years. What is that XX? I want to know. This is one option. Second option is, same SBI says deposit XX today, get 1 lakh 40,000 every year, growing, growing at 5%. Growing at 5%. What is growing at 5%? You are giving me 1 lakh 40. This year today, okay. Next year 140, okay. As every year time passes by, with 140 I can't manage my expenses. With 140 I can't manage my expenses. When you are giving today, okay, after 20 years that 140 is of no use. That 140 should have become at least 5 lakh or 10 lakh so that I can manage my expenses. So another option bank gives us, you can have a growth of 5% every year. If this they give, obviously they are going to charge a higher amount. They are going to charge a higher amount. Now, how do I value this? Okay, let's understand this now. Here, cash flow, PVF, DCF. PVF is to do the present value. Okay. First year you get, second year you get, third year you get. Unfortunately, in your notebook, you cannot be writing 100 years because you can't do calculation for 100 years. In Excel, I can do calculation for 100 years and then first show you the logical approach. Then I give you a formula. Then I give you a formula. In Excel, I go to some, no end to this. Put some 100 years, okay? 100 years is almost like infinity, okay? How much they are going to give? 1 lakh 40,000. 1 lakh 40,000. This is the amount the bank is going to give for a period of 100 years, let's assume. 100 is like infinity or perpetuity. The discounting rate I said is, let's assume 7%. The interest rate is 7%. You have to discount 1 lakh 40 at 7% for 1 year. Then for 2 years, 3 years, 4 years, 5 years, 6 years, 7 years, 8 years, 9 years. Till 10 years, if I tell you, will do it. Till 20 years, you may attempt. 30, 40, 50, 60, 70, 80, 90, 100, 110, 120. Difficult. Not possible. In the calculator and all is not possible. I can do 1 divided by 1 point equal to equal to equal to equal to equal to. You keep doing for some 1000 times and then press a GT button. That is okay. But how will you do so many calculations? So there is going to be a formula. I'll come to the formula. So in Excel, I do 1 divided by 1.07. 1 divided by 1.07. This is first year discounting, second year, third year, fourth year, fifth year, sixth year. Excel will keep doing it. Like this, I do 100 years of discounting. 100 years of discounting. And I multiply these two. This is called discounted cash flow. And after multiplying, I put a total. After 113 years, that 1,40,000 is worth only 67 rupees. Is worth only 67 rupees. The worth will keep going down. The worth will keep going down. I repeat this calculation. Maybe I reach a zero value almost. Okay, I repeated and I got these values. The total of this I did for 168 years. Okay, total of this is 19 lakh 99,977 or to a greater extent 20 lakh rupee. How can I get 20 lakh rupee without doing such a lengthy calculation? Because in your notebook, you can't be doing this lengthy calculation. Impossible. This is one approach. Okay, this is one requirement. Second requirement is you get 140. No, this 140 increase at the rate of 5%. First answer we got is 20 lakh. Okay, first answer we got is 20 lakh. How are we going to get 20 lakh? I'll make you understand in some time. Okay, you need to get 20 lakh. How can you get this 20 lakh in your calculator? Possible through a formula. Other option is start with 140, but increase every year. Increase every year. If I increase every year, it reaches some very high value and all. Don't worry about all that. But I keep increasing this. Let me do it for more number of years. I reach almost a zero value. Okay. I get the total as some 69 lakh 97,000. 69 lakh 97,000. What number will get? We'll see in some time. Okay. But the point is, perpetuity means there is no end. One type of perpetuity 140, 140, 140. Second type of perpetuity 140, 147, 154, 162, 170, 178, 187, 196, 206. Why this is needed? Inflation. Inflation is there. I keep needing higher amount. So one you give me same amount or you keep giving me higher amount. Okay. Now I want to know how will I get that 20 lakh rupee or approximately 70 lakh rupee in a formula. 20 lakh rupee or 70 lakh rupee in a formula. Any doubts on this? Your problem is you are not able to do infinite calculation. If you can do infinite calculation, I don't need a formula. If you cannot do infinite calculation, you need a formula. Clear? Able to understand this? Now, perpetuity has a formula called, no need to write anything, and then we'll do a question. That time we'll do the problem. Present value of perpetuity. There's no concept of future value. Okay, there's no concept of future value. How I do present value is best way, do it like this in Excel. Do for how many years? 100, 200, 300, 400, 500, 600. There's no end. There's no end means you'll have to do infinite calculation. Obviously, this much calculation I can't do in my notebook. So the formula is perpetuity amount of first year divided by rate of interest minus growth rate. Divided by rate of interest minus growth rate. Wait for some time. 1,40,000 first scenario. First scenario 1,40,000 divided by rate of interest is, I said 7%. Growth rate is 0%. First scenario no growth. First scenario no growth. First year amount you have to take. What's the answer you get? 1,40,000 divided by 7%, which is what that Excel gave for by doing so many years calculation. By doing so many years, there is a derivation also, but derivation I don't want to get into it because mathematically you'll have to do n plus 1 something like that and all will happen. I don't need all of that. Simple thing is rate of interest minus the growth rate. Wait. Second one, perpetuity amount of first year, assuming you get 140 in the first year, not 140 plus 5%. It can be 140 plus 5 also. Assuming I get 140 in the first year, 7 minus 5. 7 minus, what's the number you get? Which is what my Excel was giving by doing 300 years of calculation, by doing 700 years of calculation, by doing 800 years of calculation. You can do so many years, but Excel I can do. Notebook you can't do. Notebook you can't do. So present value of perpetuity is whatever first year amount. Here, every amount is going to be same only. Whether you call first year, second year, third year, fourth year, doesn't matter. First year amount only you have to take because you invest today, get the money in the first year onwards. So in the first scenario, the first year doesn't matter because it's the same amount only. In the second scenario, it can be 1,40,000 or maybe 1,40,000 plus 5%. Plus 5% means value will change. Value will change. Able to understand the calculation? Any doubts on this? Best way is to do this, which is not possible in your notebook. Let us be very, very clear. It is not possible for you to do this. When it is not possible for you to do this, you need a formula. You need a formula, and which is where that formula is coming. Clear? Any doubts on this? Able to understand this? Okay. Now coming back to this question, first the concept. Perpetuity would mean no cash flow, would mean cash flow happening forever. Since there is no end, we cannot compute what future value of perpetuity. Is the formula same for both? Yes, same. I don't want two formula. Okay, I've written two formula. Formula is rate of interest minus growth rate. Just come and write here perpetuity amount of first year. Just write that first year amount. It can be first year, first month also. First month means denominator monthly interest rate. Denominator will be monthly interest rate. First year. Perpetuity amount of first year divided by rate of interest minus growth rate. Same for both. Okay, growth rate can be there, may not be there also. Clear? Can you proceed? Rate of interest minus growth rate. Now listen, there's something called as compounding frequency. What is compounding frequency? Let's assume I create a FD, 10,000 rupees FD. Bank pays 10% interest every year. So if I create 10,000 FD, I get 10%, 11,000 year one figure. Okay. Same bank paid 10,000 I create, but instead of paying 10%, they pay 5% per half year. 5% per half year. Half year means every half year they'll pay interest. Every half year they'll pay interest. What I do is instead of paying 10% for a year, they pay 5% for a half year. Technically both are same only. 10% for a year or 5%, but you will earn more. How do you earn more? In the calculator. 10,000. First half year you earn 5%. It is how much? 10,500. Second half year, listen, you earn 5% on 10,500. 5% on 10,500. 5% on what? 10,500. So plus 5% is what? 11,025. This extra 25 is interest on interest. This extra 25 is interest on interest. Extra 25. See, first half year I earned 5%. Bank said 500 interest is there. I say I don't need money. You please add it to the FD because I want money at the end of first year only. 10,000 I created, at the end of first year I got 11,000. Second time I created 10,000, they gave 500. I said add it to the FD itself. They added 500 to the FD and paid what? 500 also interest they paid and 10,000 also interest they paid. Third option, 10,000 plus 2.5% per quarter. 2.5% per quarter. Now you will earn even more. How even more? In the calculator. 10,000 plus what? 2.5% for the first quarter, 2.5% for the second quarter, 2.5% for the third quarter, 2.5% for the fourth quarter. You get how much? 11,000. This 38 is called interest on interest. That extra is called interest on interest. Now, a bank tells you, you can create a FD with 10% interest per annum compounded annually. Compounded annually means only once a year I'll pay interest, or 9.8% compounded quarterly. Now which is better? I don't know. You can't say 9.8 is bad. That is wrong. That is wrong. I'm repeating again. 10% compounded annually, 9.8% compounded quarterly. Which is better? You can't say that 9.8 is bad or 10 is good, because if it's compounded quarterly, I will get interest on interest on interest on interest. I'll get interest on interest on interest on interest. So there is obviously a bigger benefit which happens when you have interest on interest. When you have interest on interest. So we started with 10%, got 11,000. Then we did 5%. we got 11,025. Then we did 2.5%, we got 11,038. Now, how do I compare 10% annually with a 9.8% compounded quarterly? Very simple. You will have to do this. 1 plus R by N. What is R by N is 9.8. How many times you'll do compounding in a year? How many times you'll do compounding means how many times you'll pay interest on interest on interest on interest. So quarterly means 4 times you'll pay interest. So 9.8 by 4 power 4. 9.8 by 4 power 4. For example, 11,025. 1 plus zero point 0.1. What is 0.1? 10%. Half yearly compounding means divided by 2 power 2 minus 1 divided by 2 power 2 divided by 2 power 2. That is 10% annual, 10% interest. 10% annual compounded half yearly. Compounded half yearly, you will effectively earn 10.25% here. You will effectively earn 10.25. 10.25. How will I get 10.25? 1 plus 10% by 2 power 2. 1 plus 10% by 4 power 4. 1 plus 10% by 12 power 12. 1 plus 10% by power 20 divided by 20 power 20. Like this you can keep going on. Like this you can keep going on. 1 plus 10% divided by 2 power 2 minus 1 divided by 4 power 4 minus 1 divided by 8 power 8 minus 1 divided by 12 power 12 minus 1 divided by 365 power 365 minus 1 divided by 365 means a daily compounding, which is rare. Okay, divided by 2 power 2 half yearly compounding, divided by 4 power 4 quarterly compounding, divided by 6 power 6 every 2-month compounding, divided by 52 power 52 weekly compounding. Weekly compounding. So as the compounding frequency changes, your effective income will change. Effective income will change. So somebody asked, your parents are asking, I went to the bank, I want to create FD. Bank is giving me two options: 8% compounded annually, 7.8% compounded monthly. You tell which is better. That time you can't say 7.8 is bad and 8 is good. I don't know. I'll have to do the calculation. Maybe 8 is good. I don't know. I'll have to do the calculation and then give the answer. Compounded monthly means divide by 12 power 12. Divided by 12 power 12. So every time when you take a loan in the practical world, the bank will say interest is 7%. But the repayment happens when? Every month. If you pay every month, it is monthly compounding. It is monthly compounding. So if you are paying 7% in a loan, 7 by 12 power 12, effectively you will be paying 7.5%. Effectively it will be 7.5%. When you create a FD, bank will mostly say annual interest. Annual interest means 7% means you earn only 7. But in a loan, if you also somebody created an FD at 7%, loan also at 7%, but in loan you will still be paying more. You will still be paying more because of what? 7 by 12 power 12. 7 by 12 power 12. You ask the same bank saying that okay, 7% okay, but I'll pay interest yearly. Then he'll say okay, interest yearly, then you pay 7.5. Then you pay 7.5. They'll change the rate of interest itself. Clear? Able to understand the concept? Because depends on frequency. What is frequencies? How many times are we paying interest, or how many times are we receiving interest? If you're receiving once a year, divide by 1 power 1, same answer. If you're receiving twice a year, divide by 2 power 2. If you're receiving 4 times a year, divide by 4 power 4. 8 times, divide by 8 power 8. Divide by 12 power 12. Divide by 20 power 20. Divide by 25 power 25. Like this you can keep going on. You can keep going on.